Start the recording. Brilliant. Okay, all of that stuff out of the way. Let's get started. So before I do, two quick caveats. Okay, firstly, I am completely apolitical. I do not have any preference for any political party. I actually hate them all equally, so I'm very neutral. What I focus on are the tax changes mostly, and the other business changes that are announced in these budgets and how they're going to impact you and your bottom line, how you're going to grow your business and what it means. So that's my focus. There's plenty of other stuff to cover off. I mean, there was just a calamity. I mean, I don't know if any of you actually watched it. If you didn't, I don't blame you. It's the only bit of politics I ever watch once a year or twice a year when they used to do the budget twice a year. But essentially, they just scream and shout at each other for an hour. They reel off loads of headline grabbing sort of quips. But really, there's not much detail until you look at the budget document that comes afterwards, and it's something like 300 pages. However, it was even more of a calamity this time because the OBR actually published the document half an hour before. So someone's getting sacked there, I should imagine. But I think I've been doing this for a long time, and there's always so much build up to these budget events, and there's always stuff leaked to the press. Now, obviously, it's a fairly common political tactic to leak bad news, extra bad news, and then everyone thinks, oh, the budget wasn't quite as bad as it was going to be, so it's okay. I feel like this is definitely the case in this situation. There's very little positive, and I don't like being all doom and gloom, but there is very little positive to come out of this budget. The other thing I would add to this is that it sounds a bit weird for coming on a budget update and me talking about tax, but you can't go and take any of this stuff as pure tax advice that you're going to take specific action from. And there's two reasons for doing that. One, as is always the case with tax, you need to tailor it to your specific circumstances. So I'm going to just talk a bit generically here, first of all, today. And the second one is we're caught in this balance between trying to give you the information as quick as possible. The budget was only yesterday. We're doing this today. We got a blog that went out last night, but the detail takes time to process, of which we've been frantically doing last night. But even then, they still don't release a lot of the detail. So some of this stuff is really vague statements, even in the budget document afterwards. And actually, some of these tax changes don't kick into 27, 28, some of them 29. So some of them, they're just more intentions than here's the detail. But that all being said, let's go into what we do know and what we don't know so far. Just looking down the list, we've got lots of clients on here, lots of names I recognize, but there are some names I don't. So brilliant. So in case you don't know who I am, my name's Luke. I'm the founder and CEO of Crisp Accountancy. We work with businesses of all sizes, from freelancers, contractors, one-man bands that are operating through their limited company, all the way up to the fast growth scale up companies that are seeking investment and doing big 7, 8, potentially even 9-figure exits. So we cover a wide range, but we're heavily focused on growth. So my focus here is around tax and what impacts your potential growth ability. And that being said, obviously I'm a business owner as well. So these measures that they introduce, spoiler alert, increase on dividend tax, they impact me and my family directly as much as they do everyone else. So I'm looking at them from a personal interest point of view as well. My poor old dad is in hospital at the moment, but even with, not very with it. But even yesterday when I had to go and see him, he grumbled. You couldn't really hear him too well, but he grumbled, "How much extra tax am I going to have to pay?" So, yeah, take of that what you will, I suppose. Right, let's get into some of the detail. Okay, so the first thing is let's talk about income tax. So the thresholds, i.e., the levels at which you pay the different rates of tax, have been frozen for an additional 3 years. Now, this is a funny one. Politicians like to say this isn't an increase in tax, but it is essentially it's a stealth increase because by inflation, income should go up, wages go up, and income should go up. It doesn't always work like that, I get it. So essentially, what this does is push more and more people into the higher rates of tax and potentially even additional rates of tax. Now, the thresholds are already frozen up to 28 anyway. So they've just been adding on an additional 3 years. So they're frozen up all the way up to 2031 at the moment. So that actually additional 3 years doesn't really impact anyone at the moment, but it's still quite jarring. By the time we get to 2031, unless these decisions are reversed, I think I saw that these thresholds would have been the same for 10 years. So if you take your income from employment or from your business, or you take the wages that you're paying people, like the chance of it not having increased at all in 10 years is very, very slim. So more of your income is going to fall into these higher brackets. So you know what these brackets are. We're not going to spend too much time on them. Tax-free allowance of just over 12.5K. You've got your basic rate up to 50,000, just over, the higher rate up to 125,000, and then you pay an additional rate of tax beyond that. There is that limit above 100,000, between 100,000 and 125,000, where you start to lose your tax-free allowance. So there is it's kind of like a almost a mini band within that sort of bracket as well. So those bands are not they're remaining unchanged. They're as they were. But despite the manifestation pledges of not raising income taxes, they have raised the income tax rates. Now they haven't for ordinary employment income. So if you receive all of your salary, all of your income through salary, and you don't have any dividends, you don't have any rental income, you don't have any savings income, then technically they are correct that your income tax rates have not gone up. But for everyone else, i.e., most business owners, they have gone up. So from April 27, the savings rates and the rental income rates have all gone up by 2%. So the basic, the higher rate, and the additional rate. So instead of being 20, 40, and 45, they're now sitting at 22, 42, and 47%. There was a small thing that I don't think many people picked up on the budget, and it is very, very vague at the moment. They're going to do a consultation on this, and whether they can actually put it off, I don't know. But it signals their intent. Now, obviously, they're doing this making tax digital thing where people are gradually going to have to make quarterly submissions rather than just the end of year submission for their self-assessment. At the moment, you submit it based on the 5th of April, you do it by the 31st of Jan, you pay over all your tax. Making tax digital is slowly bringing people into making quarterly submissions, starting with self-employed that earn more money and some rental income, etc. But what they have now signaled as well is from 2029 is that they have the intention that if you have PAYE income, so money through salary, and you have untaxed at source income, i.e., when you submit your self-assessment in the year, you have additional tax to pay because you've got rental income or dividends or whatever else that is. So a really common setup for every entrepreneur. Then they will start to collect that tax in advance quarterly through your PAYE tax code or potentially for your pension if you're getting in receipt of pension income. So how they're going to do that, I don't know, because they can't get anything right at the moment. And I have mixed feelings about that. I don't like it fundamentally, but we do constantly see people who don't understand how taxes work. They get to the 31st of January, they've had poor advice or no advice, and then they get this unexpected tax bill. And that's HMRC's reasoning for sort of helping you to manage that. However, for those of us that can manage it and do have good accountants advising on it, you like to keep that money, right? You can reinvest into your business, you can save in it, make a bit of interest, whatever you want to do until you pay it over. So now in 2029, you're going to be paying it over quarterly. My big issue is that how HMRC are going to know, and they are horribly inept at getting things right. So the chances of them getting this wrong and collecting too much tax are very, very high. So I think that one kind of slipped under the radar a little bit, but it's one to keep an eye on, and like I said, signals their intent. So dividend taxes. So dividend taxes went up as well by 2 percentage points. They're from April 26, though, not April 27, like savings and rental income. And to make things even more complicated than they already were, obviously dividends had different tax rates already. You can see those there, 8.75, 33.75, and 39.35%, because they don't want to make it easy for you to work out how much tax you're going to pay, do they? So from April 26, the basic rate band and the higher rate band are increasing by 2%. So you can see there, 10.75%, 35.75%. The additional rate, though, is not increasing. Now, I don't want any of those increases there, frankly, for me or for my clients. So I'm glad they didn't put the additional rate up as well. Because remember, with dividends, if you're a business owner, your company, yes, okay, it's a different legal entity, but essentially you're making profit. Your company's already paying corporation tax, potentially up to 25%, before it's allowed to pay out these dividends. Dividends do not attract national insurance, which is why they were always deemed to be sort of a more tax efficient route. But they changed all these percentages a while ago, so they're trying to level the playing field, and that's more of what they've done. The slightly ironic thing is that they talk about the richest paying more. When it comes to dividends, the richest are those over additional, which we've got loads of clients, so I don't want them to pay more tax. But the ironic thing is that actually the earnings they're going to earn over 125K, they're not going to pay any more tax on that bracket. But there you go. So if you take an example, if you're earning 100K a year, salary and dividends, and you're typically taking £12,570 in salary, then you're going to be paying an additional £1,748 per annum in tax from April 26, unless you change things up. Now, it's too early for me to go into super detail about this, but you then have the question around, well, what is the best mix of salary and dividends? Because for a long, long time, it was easy. It was tax-free allowance, in this case, 12,570 salary. The rest of the money is dividends. As they've chipped away at dividends and corporation tax, that gap between the tax you pay is more is smaller. It's minimal. So dividends were more efficient than salary, and obviously with the tax on dividends increasing by 2 percentage points, but not on employment income, so not salary, that gap does get narrower. So what you're really going to have to do is look at what your earnings are projected and sort of work out whether it is still best to do the 12,570 or some mix of salary, most of the money as dividends. I suspect at the moment from my initial calculations, it will be slightly beneficial for most, but as I said at the beginning, the devil's in the detail. There's different mixes there in terms of who it will suit and who it won't do. So I think more bespoke tax plan is going to be needed from April 26 before you go and set your salary level, essentially. So those of you that have employees, let's talk about employment costs. So, I mean, this one could impact directors as well, but it mostly impacts employees, and I would say it mostly impacts higher earning employees. So they have restricted, or sorry, they have added, I should say, national insurance to the pension contributions that employees make for salary sacrifice. This actually says employer pension contributions. That is wrong. So this was done very late last night, so apologies, but it is employee pension contributions. So if you're an employee and you sacrifice some of your salary in order to pay into your pension, then those contributions above £2,000 are going to attract national insurance. You as an employee are going to pay employees national insurance, and your company is going to pay employers national insurance. Now that's not effective until April 29, so we've got plenty of time to look at that. And this is a good example of where there's very little detail at the moment. So my reading suggests at the moment that the employer pension contributions, so where the company makes a pension contribution on behalf of the employee, still remain efficient. So if you have an owner managed business, for most owner managed businesses, where the director and the shareholder, they're probably not paying into their pension contribution via a salary sacrifice. You're probably making an employer contribution, of which you can make up to 60K a year, all sorts of rules around that. But for most, you can make 60K a year, and you'll get a corporation tax saving on that. So I think that route to pension contribution is still going to be there and still going to be attractive, but we're going to have to see the detail. Where it does impact you is if you have high earners. So typically, those that were earning 100K or maybe 125K or around those sort of thresholds that we saw earlier, so where they're going to go into the additional rate bracket, or if they go over 100K, they're going to be losing tax-free childcare assistance and those kind of things. Then what they're more likely the people that were using salary sacrifice. So as an employer, you might have employees come to you and saying, well, I don't want to do that now. I want to talk about how my remuneration is going to be structured. So it might be that you need to do something a bit different for your higher employees. But again, we need to see the detail. We've got to April 29. So that's just a heads up, really. I don't think it's going to impact too many directors themselves. Minimum wage increases. So they were announced, where are we now? The day before the budget, so 2 days ago. So April 26th. For those over 21, £12.71 per hour. So this always catches out people. Where you have lower paid employees and they're on fixed salaries, you need to go and review it, because you might not be thinking about an hourly rate for them. You might think they're on X amount per year, but you need to look at how many hours they're actually working. And it's not just how many hours they're contracted to work, it's how many hours they're actually working as well. So if they're always doing more hours, then that might be how you calculate the effective rate of pay. And you might need to give pay increases to make sure you don't fall foul of national minimum wage increases. So do keep an eye out for that. Uh, Question coming in. It's both national minimum wage and national living wage now. So yeah. Um, so those of you that have or have thought about using apprentices before, you would have had most of their training, and you're an SME, presume everyone on this call is, and all our clients are. You'd have had most of your funding, most of the training funded by the government. The big companies pay apprenticeship levy, and it all goes towards funding that. You would have made a contribution of 10% previously. From actually, I'm not sure when it's from. I think it's from April, but I have to confirm dates. But there is announced that they're going to be 100% SME apprentice funding for under 25. So when you're taking on an apprentice under 25, the training element of their costs will now be fully funded. So you as a business won't have to fund that yourself. There's some very small, very minor sort of exceptions for reimbursement of some expenses, just to tidy up a few bits around home working equipment, eye tests, flu vaccinations. They were kind of already there anyway, but they just tied it up a little bit so you can sort of give those tax free or reimburse those tax free to your employees. One very minor but missed by most people restriction though is that if you were claiming the work from home relief, so for most people it's £6 a week, it's a very small amount, or where you were justifying that there was additional cost for you working from home, and you were claiming that as an individual, so you're sticking on your self-assessment and offsetting that and getting tax relief on it, that will no longer be allowed from April 26th. You can still be reimbursed as long as it's within the allowable rules by your employer, and it won't be taxable. But you can no longer just decide that you're working from home and you're going to offset that. So a very small point, but that kicks in from April 26th. And I think a lot of people, because it was very easy to claim the £6, a lot of people would have just stuck on the self-assessments previously. So watch out for that one. Corp tax, right. So essentially, there weren't really any sort of main headline grabbing announcements for corporation tax. The main rates remain as they are. Complicated, essentially from 19% up to 25%. You've got to think about associated companies rules. You've got the relief in between from tapering from 19% up to 25%. So all of that remains the same. I'm not going to go through that. But what has changed is some capital allowances. And I think capital allowances are really hard to get your head around as a business owner, so they're quite misunderstood. So and they are complicated, right? So at the moment, if you go and buy an asset, which might be a piece of machinery, a car, something like that, something that's quite expensive, that's going to last you many years, the accounting treatment is different to the tax treatment. So in the tax treatment, you work out whether you're allowed to claim any capital allowances. So there are already allowances called the annual investment allowance. There is already a first year allowance, and there's a full costing allowance as well. So in certain circumstances, when you buy your asset, let's say 10 grand for argument's sake, you can reclaim the full corporation tax relief on those by using one of those existing allowances, and they are going to remain. If the asset that you're buying doesn't meet that criteria, so a good example here is like a diesel car, for example. So brand new electric cars are slightly different. But let's say a diesel car, you go and spend 10 grand on a diesel car or diesel van, you wouldn't be allowed to reclaim all of that for tax in year one. Instead, what you do is you use the writing down allowance, so WDA. And essentially every year you stick it in a pool, and every year you use a certain percentage of it to reduce your taxable profits. And that was 18%. That is now going down to 14%. So if you've got assets that you've already brought or that you're going to buy, you will essentially be able to claim a bit less tax relief on those each year. Now, they have talked about bringing in a new 40% first year allowance from January, but I couldn't really see many details other than it doesn't apply to cars. So most cars are still going to go into the pools for writing down allowance. So I don't really know exactly the use case for this, to be honest, because there was already a first year allowance, there was already an annual investment allowance, and there was already a full costing. So we need to see some details. But essentially, I think my gut feel is that if you are buying assets, particularly cars that are not brand new and fully electric, then essentially you're going to get a bit less tax relief. I'm going to cover this at the end as well, but one of the points here that late corporation tax return penalties are set to double as well. Now, there is a massive overriding theme. There is all the time, but a massive overriding theme of them trying to clamp down on non-compliance, non-payment of tax, anti-avoidance, all of this sort of stuff. So there's quite a few minor but significant changes to how they're going to administer taxes. The problem is for any of you that have dealt with HMRC, and obviously we have the displeasure of dealing with them constantly, is that they are, for the most part, completely useless. So what they talk about doing here and what they actually manage to put into action are probably two very different things. So let's look a little bit further ahead and talk about some future planning. So first, I want to talk about if you are planning or were planning to sell your business. What was gaining a lot of traction, and whenever anything gains a lot of traction, it always falls into HMRC's line of sight for them to attack it and think they can get some money back, but was selling your business via an EOT, so an employment trust. And what that was essentially is that you as the owner would sell your business to your employees. So your employees would own the business, and then they would repay you. So let's say they agreed £1 million for you to buy the business, for them to buy the business off you. They would repay some or most of that over a certain number of years, and they would basically use the profit of the business going forward to essentially pay you back. So where you've got a long committed team and that's the right cultural thing, that's a good thing, and it's still a good thing. It was becoming more popular because it was incredibly tax efficient if that worked for you. It was quite restrictive in other ways, but the tax relief, essentially, you didn't pay any corporation capital gains tax. It was 100% capital gains tax relief when you sold your business and you met all of the criteria. HMRC have decided, despite all of the advisors sort of saying that they didn't see this case, HMRC have decided that it was being used for anti-avoidance and stuff like that, and fraud. So they are clamping down on it now, and the relief has dropped instantly. So I think it was as from yesterday, it might have been today, but from 100% capital gains tax relief down to 50%. So it might still be fairly tax efficient, and if it's the right thing for your values and you've got the right team in place, you could still look at it as an exit avenue. However, if you were doing it because it was very attractive from a tax perspective, then you need to be considering other things. The other thing that was the big announcement of the last budget for me was around BADR, which is Business Asset Disposal Relief, or you might know as Entrepreneurs Relief, which is what everyone still calls it. And that was essentially when you sell your business, you can get a lower rate of tax. So they changed those rules significantly and made them worse for us all last budget. They haven't changed them now. So the lifetime allowance is still £1 million. So you can still make a gain of up to £1 million across different disposals in your lifetime to benefit. But the tax rates, as announced previously, are increasing. So they were previously 10%. They're currently 14%. From April, they're kicking into 18%, and that is still the case. So just be considering that if you are looking at selling your business. So those of you, and this next bit is literally the only positive bit I could find, really, frankly, and it's quite niche. But those of you that are seeking investment, so we do have a lot of investment about businesses. I can see some on the webinars who this might be applicable to. There were no changes to SEIS. So SEIS and EIS and VCT to some extent are investment schemes that businesses can use to get an investment into their business, and it's really attractive for the individual that's making that investment. It gives them tax relief. So essentially, it makes it easier to go and get investment. These are really good schemes, to be fair. The SEIS, which is the smaller one for earlier stage startups, that remains unchanged. So that's still the same. There's no changes I could see to that at all. The EIS, which is the next level up, that has increased. They've widened the scope of that, so that's good. Essentially, they kind of doubled the limit, so you can now raise up to 10 million per year under EIS, with 20 million if you're a knowledge intensive company, which is what Kik is. And over a lifetime, you can raise up to 24 million, and it was previously 12 million, 40 million if you're a Kik. So if you're doing EIS or you've done EIS, then you might be able to do some more of that. So that's good. VCTs, which are venture capital trusts, I find these pretty niche. We don't come across these too often. I don't see them used as often as people, as the government seem to think they are. Their big headline grabbing there was that they've been expanded too in the same way, but actually what they did at the same time quietly was they reduced the relief from 30% to 20%. So I think VCTs are there might still be a use case, but they were used not too widely before, and I think they're going to be even more niche now. And for those of you that have much bigger ambitions, if you're thinking of doing an IPO or listing, there's some reforms there to stamp duty, essentially to try and help companies get listed in the UK, because what we see and the economy scene is that a lot of the early stage tech companies, which we deal with a lot, raising investment here, and then as they get bigger, more successful, the market conditions are just not right. And listing in the UK or further raising in the UK isn't that attractive. So they're trying to make that more attractive. And like I said, I think that's pretty much the only thing that I could see as a positive here. Um, EMI. So EMI is a great scheme. I know some of you on this are using it already. Enterprise Management Incentive Scheme. Essentially, it's a really tax efficient way for your employees to receive shares in your business. So you want to reward them long term, help them to help you build this great business, and then typically they'll get rewarded with a payout when you sell the business. That's EMI. That's basically been expanded. So it's use case for our client base probably not that relevant because it was already up to 250 employees, but it's going up to 500 employees and a bunch of other ways in which it's expanded, but might apply to a few people. So let's go back. This one with to do future planning is really sneaky. I actually only picked up on this morning. I don't think I've seen many people talk about it. So what we do a lot of work with clients is structuring of your business. So we talk about setting up group companies and we talk about a hold co. And we sometimes might hear me talk about a family investment company. And that's a way of moving money from your main trading company and ring fencing it and investing it in other businesses or property or the rest of it. And the mechanism by which you do that was called a share for share exchange. So essentially, you have your trading company and you write to HMRC and you say, I want to set up a group company. I'm going to swap my shares in Crisp Accountancy for the Crisp Group. And I'm going to create the Crisp Group. Can I get approval to do that? They give you approval. You go off and do it. It's all it's complicated, but fairly straightforward in a complicated way, if that makes sense. However, they have talked about anti-avoidance measures with this, and where there is a tax benefit to doing a restructure or a share exchange, then it will no longer be allowed. Now, what that means, I don't know, but there's always a tax benefit from doing this in some way. So I suspect it will be much harder to get these through. Whether it's going to completely curtail it, I hope not and doubt it. But for anyone that has future plans and that around structuring a group or setting up a hold co or setting up an investment company or one of those things, which is the next level up for most people once they've sort of got cash in their business, this is potentially a big blow to that. So this is one of the things where there wasn't a ton of detail. It's pretty vague. And if I'm being frank here, the level of detail to really figure this stuff out is beyond me. so we partner with a tax consultant that does this sort of work alongside us. We're going to wait for some advice on that. But just a heads up, if you've already applied for it, because I know there's at least one person on this webinar where we've already been doing this. So if it's already been applied for and you haven't had it approved, then it should still be okay as long as it's submitted for the budget, as long as the transaction takes place, I think it's before the 31st of Jan. So, but if you haven't yet submitted and you're just thinking about restructuring into a group, then more consideration is going to be needed there. And then the other thing that was touted everywhere was the exit tax, i.e. when you become non-resident in the UK and you jump to Dubai and pay less tax and live in the sun, blah, 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 you were going to have to pay a tax hit to leave, essentially. So all of the unscrupulous providers that assist people in doing that had a field day at telling people and fear mongering that was coming and they should jump ship. And actually, I saw some really big high net worths, like the biggest, declaring non-residency in the UK before this budget. So there was obviously a lot of fear around that, but there was absolutely nothing mentioned of it. So some other announcements. So electric vehicle or hybrid vehicle, there was loads of changes to this. I'm not going to go into all of this. This isn't really too much my field. But one of the things that, as you can see, made me chuckle was that a mileage-based charge from 2028. So they're essentially going to charge, I've got a hybrid, so they're essentially going to charge me a certain amount per mile for every mile that I drive. How the bloody hell they think they're going to administer that, I have not got a clue. And actually, I just listened to Reg Reed, someone interviewed on this morning, I think it was, and she didn't have a clue either. So this is a prime example of them putting something in and not having a clue how they're going to deliver it. She mentioned it'll be tracked on your MOT and guessed, and you'll pay in advance. So you can imagine all the problems with that. But also, when you buy a new car, you don't get an MOT for 3 years. So what happens for the first 3 years when you buy a new car? So God knows. But I think, again, what you can tell by these sort of announcements is you can tell where their intent is going. So previously, they wanted everyone to have an electric car. So they made the tax benefits and all the rest of it good for individuals, they also made it really attractive for employers to give their employees cars through the business that were fully electric, or owners to have fully electric cars. And that is still the case, but they just chip away at that. So there are benefiting kinds now if you have fully electric cars through the business. If you got a hybrid, it's less attractive than it was previously. And now they're sort of realizing that as people start to switch over to fully electric, that they're missing out on fuel duty and all the rest of those things. So now they just find another way to reposition it and reclaim that back. I kind of mentioned this already, but there is a large increase on HMRC on compliance and debt collection. We've seen this over the period that they've now got powers to go into your bank account and take taxes, for example, and certain circumstances. So you can imagine how well that goes down. All sorts of stuff. Devil's in the detail, but all sorts of stuff around some of the ways in which they're tightening up what they deem to be non-compliance and how they're going to close the tax gap. The tax gap is something that gets talked about every budget, and it is essentially the difference between what they believe they should be collecting in tax and what they actually collect in tax. And the difference comes from either non-compliance or anti-avoidance or tax planning or fraud. So there was quite a lot of stuff around fraud. You would have already seen this stuff, the crypto exchanges talking to HMRC, the platform that people sell, and or the gig economy, sort of tying up on the sharing of data quite a lot, so that HMRC know what's going on a bit more Big Brother style. So yeah, we'll have to see what impacts there. There was an interesting point, again, fairly niche, but the e-invoicing, where it's a VAT invoice is going to become mandatory from 2029. I don't think that will happen. But essentially what e-invoicing are is they're a way to submit invoices electronically and receive them electronically. So you don't have this sort of, at the moment, if you're operating efficiently, what you've got is something like Dex. If you're one of our clients, you're probably using Dex. You get the PDF in, Dex reads it and scans it. You check some details, or we do if we're doing the booking for you. We push it into Xero and then you pay it. Essentially, it's kind of communicating from end to end user automatically and putting it into your system. So I like the idea of that. And actually, Xero have had this in place for a few years already. So if you use Xero, fine, they already do it. Other softwares, presumably after that announcement, yes, they'll be scrambling to get that in place, but it's a few years out. But I just can't see them action in that. That seems, yeah, great for me and for a lot of my clients. We're quite tech savvy as a business and as a client base, but there's still a ton of people that can't even comply with Making Tax Digital because they can't even figure out how to use basic software. So invoicing seems like a stretch to me. But again, there was a lot of digital transformation stuff in this budget announced. ISAs, so I don't advise on personal investment stuff. I'm not allowed to, nor would you want to take my advice because it's not my area. But obviously, ISAs were quite an attractive thing that many people used, make tax-free investments, and the way the investment grows, you don't pay tax on it, and the dividends that come out of it, you don't pay tax on them. Or if it's a cash ISA, or the interest, you don't pay tax on it. So the limit was 20k per person. That limit remains, but it was 20k either as a cash or an investment, so stocks and shares. And you could mix and match that how you chose. Now you're not going to be able to mix and match that. You can still do 20k, but only 12,000 of it can be in cash. So you can still do 20k in shares if you want, but you can't do 20k in cash unless you're over 65, in which case you can crack on and still do the whole amount in cash. Mansion tax, yeah, again, not my forte, not my speciality, but if you've got a property that's valued over 2 million from 2028, then you're going to have to pay more there. I mean, again, another good example of I'd be interested to see how they're going to value houses instantly on the 2028. Valuation of houses can be quite subjective at the best of times. And whether it's a 1.99 million valuation or 2 million will be interesting. But again, if you've got a house or property that is over 2 million, you're going to pay a bit more. It's essentially as easy as that to understand. And then again, another little small one coming in, but custom duty to apply on all parcels of any value. Now, I caught this in her speech, and her thing was to protect the high street. I think it's gone far beyond that already, but to protect the high street and essentially sort of making e-commerce businesses, essentially those that are delivering, they're having an advantage about making them sort of more aligned with the high street, try and protect the high street. So if you have an e-commerce business, particularly you're delivering or importing packages, then this one may apply to you, may hit you hard. So Uh, right, action. Well, the problem is with a lot of these budget announcements is it's more just informing you because a lot of the time it's like, well, there isn't actually much you can do. You just swallow it and find other ways to make more money through commercial ways in your business to mitigate the extra tax you've got to pay. So that's always the case. However, I think going into the new tax year from April 26th, I think it will be particularly important just to review your salary dividend mix and make sure you've got that right specifically to you. It might be it remains unchanged, that mix still there, but like I said, it is the benefit is lower. So there's other reasons for receiving salary over dividends, for example. You have to have accounting reserves, i.e., profit after tax, to pay out dividends. And as advisors, we always see where businesses are struggling a little bit, they're not making the profit, they're taking money out. They think it's a dividend, it's not. It has to go as a direct loan, and there's consequences of that. So it kind of avoids some of that if you take a salary. And some we've got clients that prefer it because they get the tax deducted at source as they go along. They don't have that worry at the 31st of January. But then, like I said earlier, some people actually prefer it. They want to have the cash and keep the cash as long as possible and not have it in HMRC's pocket. So it's a very sort of bespoke thing about what works for you. Um, but what you will want to do is you want to review what dividends you take before the 5th of April, because if you're not using up all those sort of uh, allowances, whether you're trying to talk about using up the high rate allowance or the base rate allowance or whatever it is, then you might want to be declaring some extra dividends in the current tax year, so before the 5th of April, because if you declare them on the 6th, then you're going to pay an extra 2% if you're in the basic rate or higher rate bracket. So use that as your tax planning about looking at what you're doing to wrap up this tax year, as well as moving into the new tax year ahead. Pension planning, although I don't think this is the major point for now, but just keep an eye on that. In terms of if you've got higher paid employees who are doing salary sacrifice. I mean, salary sacrifice is available for anyone, right? But my experience just tells me that not many people are using salary sacrifice to do pensions above £2,000 unless they're already earning a significant amount of money. There are exceptions as always, but look at that. Keep an eye on what the rules come out as regarding employers' contributions. Hopefully, like I said, as business owners, you can still lump in 60k a year into that as an employer contribution, but I don't know. It remains to be seen yet, basically, at the moment. And then just looking at how these sort of payroll costs, if you've got to change the remuneration for your higher salaries, or if you've got lower salaries and they're increasing. And the other thing about the minimum wage increasing is they always talk about, well, the lowest paid deserve more money to live. And I don't disagree with that at all. The problem is you flip your hat and wear the business owner hat. It's not just going to be your lowest earners, because if your lowest earners on minimum wage are suddenly getting an increase, then that has a knock-on effect on everyone else. The person that was currently earning £3,000 or more because they had a little bit more experience or a little bit more technical skill or responsibility, whatever, they're suddenly going to want a pay increase as well. So it does push pay increases across the board, which for individuals fine, but for businesses, if you're operating on already tight margins, particularly if you're in any of the industries that really struggle at the moment, hospitality, etc., where the margins are sort of paper thin and typically they attract or offer salaries out at minimum wage, is going to have a big knock-on effect for you. So you're going to need to understand what those extra costs are, and be looking at your cash flow forecast as well. I wish I had structured this to sort of have some positive news to wrap up on, but really there isn't much there going. Like I said, if you raise an investment, fine, there's potentially some positives. Although if you're early stage and doing SES, it remains unchanged, but SES is still a good route in. If you're an owner managed business focusing more on extraction, i.e., getting your profits out, that becomes more expensive. Whether it's because you can't do your salary sacrifice of your pension, whether it's because you're paying more on your dividends, or you've invested in rental income and you're paying more on your rental income, or that you were looking at doing a group restructure and you hadn't already done it, and we're going to use that sort of mechanism. Like I said, it's yet to be seen how that kind of impacts it. So there are a couple of questions around national minimum wage. I've answered that one already. That's fine. If you have any other questions, just stick them in the Q&A for me. If not, then we will wrap up. Like I said, what I would suggest is, if you don't already, and if you're on this webinar, you probably already do, but make sure you subscribe to follow us on our socials and our emails because a lot of stuff will come out over the next few weeks, well, potentially next few years, with some of these announcements being further off. And whilst we try to, I think I've managed to catch kind of nearly all the headlines, but there will be some that were buried away that slipped through. But it's the detail on some of this stuff. Like I said, the capital allowance and the pension, there's very little detail to go off of. So what normally happens, the normal mechanism is they make these announcements, and then they'll publish either a consultation doc if it's further out for a couple of years or something fairly major, and they'll talk about it with you, listen to your opinions, and then ignore them and do what they were going to do anyway. Slightly cynical, but it's true. Or if they're not going to do a consultation and it's something slightly smaller, or they've already made their mind up, then they will just issue a policy update paper, and then that will normally invoke some sort of feedback and say it doesn't include enough detail, and then they'll issue that. So the main point of that is that stuff will come over the coming weeks, so keep an eye on it. As for immediately, really the only immediate thing there is if you were about to do an employment ownership trust, exit, stop, reconsider, reevaluate, check what's going on, because that's changed immediately. Otherwise, the stuff in there that comes in from April. So thank you very much, everyone, for joining in. If you've got any further questions that pop up, get me on DMs in social or just ping me an email, and I'll happily address them. But yes, thank you very much, everyone. I appreciate you all turning up.